Hello and welcome to another episode of FinTech Focus TV, powered by Harrington Starr, global leaders in financial technology recruitment. Head over to harringtonstar.com where you'll be able to see some of the greatest jobs in financial technology recruitment across the world. You'll also be able to find a host of insight to help you grow your brand, your team, your network and your career. You can see the latest financial technology salary survey. You'll be able to download the issue of the Financial Technologist, focusing on the appetite for disruption. And our latest Top 1% Workplace Awards will be out at the end of this year. If you work for a company that's a great place to work in financial technology, we want to hear from you. Enjoy the show, and I'll see you soon. Hello, and welcome to another episode of FinTech Focus TV with me, Toby Babb. Today, I am absolutely delighted to welcome back onto the show for maybe the fourth or fifth time now. It's an annual thing, and each time I absolutely love it. Mark Beeston, how are you?
I'm great, Toby. Great to see you. Thank you for having me back.
Oh, it's always a pleasure. It's always one of my favourite episodes because I feel like it's like an annual treat to find out what's going on in the marketplace, what's going on with Illuminate, and everything you guys are doing, which is constantly progressing and constantly moving further forward. So we'll dive into that. But I loved, and I think that every single time we've spoken, there's been something that I've taken away, and it's a gem that sort of moves on for the next 6 months in my head that we're doing. So I'm looking forward to finding out what that is this year, speaking a little bit more. But before we get into all of that,
no pressure.
Yeah, exactly. Yeah, I'm going to be very disappointed at the end of this if I haven't got something there which I'm quoting to everyone for the next 6 months. But there'll be people there who haven't necessarily caught the last couple, so we won't talk about everything we spoke about so far. But give us a brief intro to yourself and Illuminate Financial as well.
Sure, fantastic. Well, thanks for having me back again, as I say. So I'm Mark Beeston. I'm the managing partner and founder of Illuminate Financial Management. We are a nearly 10-year-old venture capital firm focused on institutional financial technology solutions. So B2B solutions that serve financial services, could be fintech, could be enterprise tech, managing 3 funds across London, New York, and Singapore.
Fantastic. And it's, as I say, it's been doing incredibly well. We've seen a journey where over those 10 years it's sort of developed. So I remember talking to you when sort of Fund 1 first appeared. We spoke what seems like only months ago about Fund 2, and then I've been reading a lot about Fund 3, which you just sort of filled me in a little bit about before we came on air. But tell us about that sort of journey and where you are at the moment. And I think it was May, wasn't it? You announced Fund 3. Pretty impressive numbers behind that. Tell us a little bit more about it.
Sure. So as you say, in May, we announced the final close of Fund 3, which is the third fund in our series of FinTech Opportunities Funds. So Series A focused funds. The first one, in terms of the progression that you sort of referenced, first one was £35 million. We invested in 12 companies. The second one was just over £70 million, which we invested in 20 companies. And pleased to say that we've just closed this one at $235 million. So if we consider the first one's $50, $100, and $235. So a nice uptick, which actually is kind of important in terms of not just the underlying growth of round sizes that we've seen over that time. It will allow us to invest in a few more companies, so maybe 25 companies rather than 20, to take more of a lead role, which we were able to do on the first fund, but the inflation of round sizes on Fund 2 made that a little harder to do, and also allow us to kind of follow on with reserved capital, sort of deeper into the capital journey of the companies that we invest in. I think the thing that's really exciting for us as Toby is that we have a very strong industry partnership model. We had 3 institutional LPs, we call them strategic LPs, on the first fund. We had 4, which included our first 2 banks, which are Barclays and JP Morgan, on Fund 2. And really excitingly, on Fund 3, we've just closed with 9 strategics, right? So on top of Deutsche Börse and S&P, who have anchored all 3 of our funds, Barclays and JP Morgan, who were those first 2 banks in Fund 2, we've added Citi, SGX, BNY, Mellon, Euroclear, and Jefferies, and some very different types of organizations there. So not just big US banks, different types of exchange groups, different infrastructure players, which gives us a lot more exposure to the underlying problems in the market, which is what we really want to find solutions to, and gives us a lot more warm connectivity for the sort of companies that we are investing in, to really kind of help them stand a good chance of hitting the market need and getting that sort of critical early stage adoption that leads to value creation in the long term.
I think that's fascinating, isn't it? And you mentioned there about the sort of wanting to solve the underlying problems of the industry, of which there are many, and there's many problems which I think technology tries to fix that doesn't necessarily need fixing. I'm interested. Going back to those catchphrases over recent years, the ones that sort of immediately spring into my memory is that you'll remember writing in one of our magazines about the sort of the petrol on the bonfire of growth within the industry from COVID.
Yeah.
We then spoke about the sort of 3 generational opportunities that were sort of colliding at the same sort of time, which I think were digital assets, ESG, and cloud. From memory, if I'm not misquoting you there on those sort of 3 things that came together. I'm interested to see when you talk about the problems or opportunities, because I think that they're roughly the same thing in this industry. Where do you see that in that sort of institutional B2B financial technology space? What do you see as really needing to be fixed? What's broken at the moment?
Well, how long have we got? There's no shortage. I think it's also kind of worth just taking a step back and saying, when we think about things that are broken, there's stuff that needs fixing today, but there's stuff that will take a long time to address, right? And so, I mean, which is good and bad, right? It means adoption cycles can take a while, which is the bad side of it. The good news is, of course, any pot of capital that we raise has a 10-year view, right? So I often say the entrepreneurs we invest in, we want them to be 3 months ahead of a problem, not 3 years ahead of a problem, right? Not least because the funding cycles that they kind of go through, if you're waiting 3 years for your next piece of adoption, that's going to be challenging. So in that sense, somewhere in the middle lies the truth, right? As you sort of just referenced, we set the firm up around what I perceived at that time as the generational change required in capital markets infrastructure, and cloud was a major part of that. Ask the people that you talk to, right? Like, we are still only in the foothills of that journey, right? I talk to CIOs of banks who are like, we don't have anything going on multi-cloud yet. People might be 20% of the way along that journey, right? Which is quite remarkable, bearing in mind we're now sort of 7 years into that first fund. The generational change opportunities that you already referenced, ESG, institutional digital assets, I think carbon needs to be kind of singled out as probably one of the core focus areas within ESG. And so that's become pretty important. Data in all its forms, data governance, obviously everybody's talking about ChatGPT and AI these days. Yeah. Really important to recognize that as exciting as that is as a technology, we are again focused on this sort of mission critical, highly regulated world of finance.
Yeah.
You can't introduce black box solutions that you can't explain your outputs to a regulator in a lot of areas of the business, right? Yeah. So that's kind of one of those intersections of exciting technology, which equals technology that people in technology love talking about. That is not necessarily the same as what actually will be an adoptable solution. Right.
I absolutely agree with you on that, and I'm sorry to cut in, but I just think it's so relevant because you meant, I think cloud, when we were talking about it last time, you talked about COVID being the petrol on the bonfire for it.
Yeah,
and I agree with you about how adopted it is. It was almost a very reluctant sort of pull in 2020, where cloud became a much more adopted sort of thing within financial services because it had to for a couple of years. And I definitely sense that sort of slow growth, which I think is something which holds us back in the industry to really sort of embrace everything. I think the other side of what you're mentioning there about ChatGPT and AI is it keeps coming back to that whole concept of the technology being approximately right, which isn't good enough for financial technology, right? So it's one of those things where I think you're right, in a hype cycle, it's a lovely thing for everyone to talk about, but how it gets used is still very much being explored at the moment, right?
Yeah, look, I think we're already seeing within our portfolio, there are a number of companies that are using it to augment, explain, make easier to utilize the solutions that they have. But even where we've sort of previously invested in earlier generations of machine learning and AI, we've been very, very focused on finding solutions that are the glass box solution, right? i.e. human interpretable output, right? So again, so that you can explain why your computer told you not to look at all those suspicious activity reports, or that you didn't need to look at those anti-money laundering false positives, not just because the computer said no, but because the computer said no, we don't need to, and here is why. Here are the confidence intervals, here are the data, here are the patterns that a human operator would have looked at and decided these are not the ones to dedicate more investigation to, right? So you sort of alluded to it earlier. One of the challenges in our industry is technologies looking for a problem. We've talked about that. We've talked about that before. This is definitely a very exciting technology. It will find lots of problems to attach itself to. It has to do it in a way that's adoptable by our industry.
Yeah, no, I absolutely agree with that. And I think it sort of makes it interesting for you as to look at those opportunities, because I think one of the things about the sort of continuous growth of Illuminate is the volume of people who you're seeing and the volume of interesting technology. I mean, it must be very, I tend to be a spender rather than a saver. And I think when you've got that sort of pot that you've just talked about as a fund, it must be really tempting to look at a number of the companies who are there and recognize the things that are doing, recognize the brilliance and the potential of where they're going through. But you've also talked about a pipeline that is, you know, extraordinary in terms of the numbers that you just mentioned to me before we came on air. Tell us a little bit about the level of interest you're having and what's driving that, and alongside that, how right now in this sort of, and we haven't even mentioned the climate at the moment, right? There's a lot we can talk about within that, and I think if there's one thing that's dominated the headlines in technology, financial technology included, over 2023 so far, it's been about the rapid change of funding and the difficulty of fund, the timescales of funding, etc., etc. That means that there must be an awful lot more people coming to your door. That must mean it makes it even more difficult to make those sort of calls on it, or conversely more opportunistic. I'm just interested. There's about 15 questions that I've thrown at you there.
Yes.
Catch it and make it as you will.
There you go. Like any good politician, I'll answer the question I want to answer rather than the 17 you just asked. So maybe we start with like a little bit of sort of like self-deprecating humor, or maybe it's not humor, but it's definitely self-deprecating. You touch on two things that I actually really did not know the answer to, right, when I set Illuminate up. Like, I think the two sort of hardest questions for me to answer when I was first fundraising for Fund One were like, okay, you're an emerging manager. How many funds is this opportunity? Right? Like, if one fund is a 10-year cycle and you deploy over a 3-year period, people don't want to back you as an emerging manager if you're going to be successful, but it's only going to be 2 funds, right? So how long is the problem, right? Which kind of comes back to what we were sort of talking about in terms of, we're only 20% of the way down that sort of generational refresh of infrastructure. And then the other one was like, great that there's a perfect storm creating an interesting pipeline. Like, how long will that pipeline last, right? And again, the perfect storm that led to me kind of setting the business up was 5 years post-financial crisis, huge amount of domain expertise being let go in financial services market at the time, rendered into a world where cloud tools, AWS, made it a lot easier. So it was a perfect storm for ideation and innovation, right? So fast forward to today, and I think we have a much better sense of the answer to both of those questions. Number one, we're in the harvesting period of the first fund, and we're still only in the foothills of the journey of that technology refresh. So this is going to be a great number of funds to kind of come out of that opportunity alone. The pipeline has grown like crazy. It is astounding. When we were sort of in the middle of raising Fund 3, we were talking about being nearly at 5,000 companies that we had seen. I always used to talk to seeing 150 companies a quarter. In the first half of this year, we saw just under 1,000 companies. It was over 150 companies a month. We've already gone through 6,000 companies, right? So actually, the volume of what we are seeing is higher than it ever has been. Now, is that because there's actually that much more innovation going on, right? I don't know that is the answer. I think it's a confluence of factors. I think we have a larger team. We can do more outbound. Our brand has built. as you mentioned earlier, we're not just focused on the capital markets refresh opportunity. It's all those other kind of adjacent opportunities as well. So a broadening mandate, a broadening team footprint has really kind of led a lot more kind of opportunity to our door. We have to be careful, to your spend versus save analogy, that just doesn't turn into an absolute free-for-all. We've only invested in probably 1 in 135, 1 in 140 companies that we've seen to date, right?
That's only going to get bigger as well, isn't it, that number?
Well, I hope so, if we do a good job, right? I mean, we have to filter well, we have to gate well, and really only go after the best opportunities. One of the things that is really exciting, however, about having our largest ever pot of capital is, to your point again, the macro funding environment, right? The market has become risk off. Valuations have significantly reset, and it's taken time for that to really kind of wash its way through from the public markets reset of 18 months, 2 years ago, through to the earlier stage financing space. I think we only did 3 new investments last year, despite the fact that we had this new pot of capital. We did 2. We did 1 out of the last investment out of Fund 2, and the first 2 investments out of Fund 3. We've already done 3 new investments this year out of Fund 3, but we were kind of waiting for those valuations to, if not bottom out, then at least kind of return to more normalized levels. But yeah, I mean, it is very exciting to have a large pot of capital. I think this is going to be a great generation set of vintages for returns for those that have capital to deploy and are willing to do it.
I absolutely agree with you on that, and I think it's a very interesting that there's times when it's good to be on one side of the fence, and there's times when it's good to be on the other. I mean, I think we know where that dynamic sits at the moment. But actually, I think it should always be where everyone wins in the process. And I think this time, to me, has probably filtered out some of the better companies who are attracting money at the moment. I think there's some poor companies who are able to do that in yesteryear. And actually, I think the valuations have probably got a little bit more accurate, which means that people are backed in a much more sensible way and are able to sort of drive those businesses on. So I think it's a very exciting time for companies who are raising at the moment.
Yes.
And I think it should lead to a much more successful equation at the end of it. I want to talk a little bit about that because I speak to a lot of people I can think of examples this week of businesses who I think are good businesses who are closing down because they haven't been able to raise money, or they've run out of runway, et cetera. And I think about a lot of that sometimes about how well they present themselves to investors, or where they go to, with that sort of proposition, or what their expectations are, et cetera. Because I can't remember if it was you or maybe Alistair Haynes who said that good companies should always be able to raise money no matter what the sentence is. You can steal it if you want, if you like it enough. But it was one of the 2 of you. I remember you doing you back to back on the same day, and it was like a treasure trove of content for it. But I want people to think, right, if they are investor ready and they are going to try and raise at that sort of stage. We've spoken about this a little bit before, but I wonder if it's changed. It's changed about what are some of the things that you're really looking for if you're taking 1 in 150, 200 odd companies and investing money into them, and you're seeing 6,000 people all looking for the same sort of pot, the same sort of opportunity, and you're in demand. What are people doing that are really impressing you? And it won't just necessarily be about the markets they're in that align with I know that's part of it, but what can they do to really stand out?
Okay, so you're going to end up having to remind me of the second part of that question in a second, because I'm going to address the first part of what you said first. I don't know whether it was me or whether it was Alistair, but I was actually literally going to say exactly what you said. With a small caveat, I would say mostly good companies should be able to secure fundraising. There's still an immense amount of dry capital out there, right? I think what has fundamentally changed is what is the benchmark for a good company. Right. And I don't think it's changed fundamentally to what people thought 10 years ago, but I think it has changed fundamentally to what people thought 2 years ago or 3 years ago. Right. Mm-hmm. And so one of the good things for us as an investor, but also it won't always feel like it, but a good thing for somebody that is potentially flogging a dead horse within a startup, of the current fundraising environment is that there are these kind of zombie companies that should have died a long time ago, that because of an excess of liquidity in the system have managed to maintain some form of capital injection, sort of keeping them going probably a long time after in a normal market they should not have. And that is not a good use of people's capital, but it's also not a good use of people's time, both the investor's time and the entrepreneur and the team's time, right? Which is, I think, one of the really important pieces of the industry rhetoric around failing fast, which I think is often misused, right? Like succeed fast is the goal, but if you are going to fail, don't fail slowly, right? So seeing a few of those kind of companies taken off the board isn't actually a bad thing candidly for everybody involved. It might not feel like it at the time. Not a lot has changed in terms of what you're looking for, right? I mean, yes, as you identified, we want it to be in areas that we are sort of focused on, have a developed thesis around, right? But you are looking for high energy, world-class teams that have great domain expertise, really that kind of charisma to build a team and charm a client and get early adoption, the nuclear energy that you need to kind of force that process through when you've knocked on 19 doors and you've had 19 no's, that you're still going to knock on the 20th with the same enthusiasm you knocked on the first one. Coachability is really important. And I think we may have spoken to that before, but coachability to me means you don't have to do what we say, but we have to be able to talk to you about what we think, right? You run the company, we will give you capital, we will give you connectivity, we will give you advice. You don't have to take it, but certainly we need to feel like that's a two-way conversation. So it's as simple as that, right? My big learning, if any VC tells you it's team, 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 I used to say team and product, it's team, 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 right? We take the fact that the product is a good product almost needs to be a given. It really, really comes back to the team.
So this is an interesting thing for me, because having spent 23 years in the recruitment industry, I recognize that there are a lot of people who glitter during an interview process who might not necessarily be as robust as they may seem over that sort of piece. So when you're hedging the sort of investments that you are into these business, I say hedging, but you're putting the investments which you are into these businesses based on the power of that individual. And when you're talking about how many people or teams, when you're talking about how many people who you're seeing, how many frogs you're kissing in that sort of process, there'll be a lot of people there who are able to polish up a very impressive deck and put their best foot forward and charm, etc., etc. How do you look behind that? And look, you've got an incredible track record as a business in getting it right, where a lot of companies haven't done it. And I'm not saying it's foolproof, but it's a super impressive track record that you guys have built over the last 10 years in making that sort of decision. So I'm really interested when you're making a person-based decision and it's team, the evaluation of that team and what gives you the confidence to say that is not just glitter, but it has something behind the veneer when you scratch it back.
Wow, really good question. I think the important point to kind of recommend, again, I'm an ex-trader, and in this sense, I don't think the venture business is any different to trading, right? It's a risk business and you get things wrong all the time, right? So I'm not going to answer the question in a guru-like manner that says, hey, we get it right all the time. We don't get it right all the time. Hopefully we get it right in aggregate more than we get it wrong, right? And whether that means number of companies or whether that means the amount of capital that we put to work in the right ones versus the wrong ones is really kind of where the answer lies. So there is no magic answer, right? We are evaluating those teams based on our personal interactions, based on the feedback that we can get from the market, from other people that have interacted with them, people that have worked with them, people that they've sold to. I think one of the good things about our team being more experienced and larger and also having more collective data points within our own portfolio, you kind of definitely start to develop more of a feel for it as 23 years in your industry does the same thing for you, right? But it is no different to hiring a candidate, right? You develop your view on the way in. You pull the trigger one way or the other. If pulling the trigger means you're now in business with those individuals, or that individual in your case, That's when the learning really starts, right? So there isn't a foolproof answer, is the reality. But it's important to recognize in the investing business, you're not just choosing to invest once, right? Yeah. We expect when we invest in an early stage business that we are going to be putting capital to work from our fund for 2 or 3 rounds, typically. And actually, if we still like the business and we don't have the capital or we've hit the concentration limit on the fund, we will go and offer those opportunities through a sidecar type vehicle. We've done a number of SPVs to do follow-on investment and invite our investors or other investors into those opportunities, right? So you're constantly refining your model of who you're working with and how effective they are and the pluses and the minuses of it. And again, that could be a 10-year or more journey. So that upfront filtering is really only the first part of it.
I think it's fascinating. It's a really interesting piece. And I think that calibration of a team is such a hard thing to do and to do well. And it's really interesting to get your insight into what you're looking for within that. I want to look at this market, because you say that there's been re-rating valuations, there's been funds that have been difficult to raise. You guys have stood out in that, in going 2.5 odd times larger than ever before. So it's bucking trends. I want to get your take on the way of the world at the moment, the market at the moment, and what you guys have done to allow that to build that face, to attract those logos, to attract those names, and what's going right for Illuminate. I know you probably won't want to puff your chest out too much at the moment on that. It's always a difficult thing with a humble man such as yourself to do that. But blow your trumpet for a while, because I think I love celebrating success, and I love seeing people who are doing well. And I'm really keen to see why you are, in your view, backing the trend on that. I've got my thoughts, but I'll be keen to hear yours.
Well, you're very kind, and pride comes before a fall. So I won't puff my chest out. I'll go back to another kind of trading analogy that I use with my team all the time, which is better lucky than smart, right? So definitely tell my team to work smart, not hard, right? Or feel free to work hard, but work smart first. But better lucky than smart still holds, right? So I think it's a combination of things. Number one, yes, it has been hard. The fundraising environment has been really, really tough, right? I think the luck there was that actually our largest fundraising business model problem actually bizarrely became a strength, right? So like, if there is one gap in the Illuminate model, right, it's that we haven't really established ourselves yet with the sort of endowments and foundations that over time will turn us from a multi-$100 million manager to a multi-billion dollar manager, right? That's on me. There's work to do, and we do that in every fundraising cycle and out of every fundraising cycle. But our core base of institutions, the strategic LPs, has only gotten stronger, and they are not evaluating deployment of capital into the innovation space in the same way that those institutional investors are, right? Institutional investors were very, very, and still are very, very risk off for private markets because of this thing called the denominator effect, where if you felt like you had a balanced portfolio of private investments and public investments, and your public investments dropped by 40%, all of a sudden you're overweight privates, right? It might be the best opportunity in a decade to deploy capital into privates, but they go, oh, we're overweight versus our model because the private stuff doesn't re-rate as quickly or as accurately as public markets do, right? So we weren't beholden to that, right? Like maybe we could have raised more actually if we were better at that. But meanwhile, the strategics are kind of looking at it going, there's more problems than ever. The amount of spending in the space hasn't gone down. Actually, the collapse in valuations is going to be an opportunity for us from an M&A perspective over the next few years to bolt on capabilities. It's a better time than ever to have capital at work in that space. So I think that's one element. Then the other element is, and you definitely sort of read about this in various places, if you are a fund that was a 2014, 15, 16, even 17 vintage fund that didn't take money off during the what we now believe to be probably inflated valuations of 21, 22, you're going to find it very, very hard to raise money. And we're very fortunate. We had 12 companies in Fund 1. We've had full sales of 5 of them and partial sale of 1. We partially sold another company. So actually it's full sales of 5 and partial sales of 2. And the net of that is we've returned 1.5 times our capital to our investors on that fund. And that puts us in the position where, for 5 quarters, I believe now in a row, we've been the number 1 European VC of 2015 in terms of distributions. We're not the number 1 in terms of the mark to market, but there's an awful lot of high mark to markets that haven't distributed anything at all, or have distributed a very, very small amount, right? So I think at this point, like, distributions counts for a lot. And we're fortunate to have a strong story there because we weren't greedy.
That's exactly what we were talking about before, wasn't it? That I've always been a believer in a win-win scenario, and I think that sort of phase where the valuation people were pushing, owners were pushing for unrealistic valuations was crazy at that sort of stage. I think people who are taking advantage of the situation at the moment are potentially short-termist in thinking as well at the same sort of time, and I think that sort of fairness, which I don't think is a particularly commonly used business term, but I think it's such an important aspect as to where it goes. And I'm really pleased that you said that and how it comes through.
I'll say one more thing, Toby, if you don't mind. Yeah. I do think it's difficult for people in our position, right, like other managers, because again, our investor base being predominantly corporate, and we have a lot of families, whatever, but again, not traditional institutional investors. A lot of the rhetoric from those institutional investors is they want digital outcomes, right? Like, they don't quite say it like that. But if the market had continued to grow up, we would definitely not be looking very smart, right? If you take half your position off in a company and then it goes up by 20x, by the way, you still get to do 10x.
Yeah,
but it's only half of what
everyone's always going to be looking at. Yeah, exactly.
Right. Now, again, we take a sort of relative value trading, almost trader oriented kind of view of risk reward, right? Let's bank some. And if we can still 10x from here, let's do that. But there's an awful lot of institutional investors that I think would look at that and say, oh my goodness, you left so much value on the table if that outcome had come. And so, but the problem is that the market went the other way, and those same investors are the same ones that are telling people, hey, if you didn't distribute during the last couple of years, don't even bother phoning us. So you're kind of trapped between a rock and a hard place. I think it's quite hard for managers to kind of manage against those mixed messages, to be frank.
But I think alongside that, what you mentioned before is better to be lucky than smart. But I'm not a massive believer in luck at the best of times. People who work with me will hear me say quite a lot. And I think what you're talking about there is being sensible in between elements, and that usually is the strategy that plays out. It's considered as to where you were. It wasn't looking at how can we get the absolute maximum out of this side of things, just as it wasn't if it went the other way, we'd be looking stupid on the other side as well. So I think there's a lot to say for what you've spoken about there, and we'll call it luck, or we'll call it smarts, we'll call it a strategy, whichever way it was. It seems to be working well for itself.
Was it Greg Norman that had that great quote, right? It's really funny. The more I practice, the luckier I get.
yeah, exactly. Yeah, that's also a well-trodden Toby Babb quote in the office, which I've stolen from many people down the years. I want to look forward a little bit, because I could be talking to you for hours and hours and hours, and I know that I've also got a taxi coming to the airport in the not too distant future. So I have 3 very grumpy kids and a wife looking at the door very, very soon. So I want to finish up with the next sort of phase. So much has been achieved. We know a little bit about now where you're heading with Fund 3, and it sounds very, very exciting as to where it goes. We're seeing the team grow. We're seeing opportunities grow. We're seeing you do different things as the company continues to evolve, which is why I love having these every year to see that sort of growth as well. But tell me what we can expect.
Well, I think, again, with good luck and a following wind, I think there's a massive opportunity that has come from the sort of the revaluation and sort of risk off nature of a lot of participants in the market. Series B activity has absolutely collapsed. We've now, as I mentioned earlier, we've tracked and continue to track 6,000 odd companies that might have been not the right stage for us at the time, or we may have passed on good opportunities. I think that there's a serious early stage growth opportunity coming, and I'd like to try to launch a early stage growth fund, probably in the first half of next year. We definitely have interest in that from existing investors. And so that's a lot of what's going on in the skunk works right now. Don't tell anybody.
No, so it's our secret. No one's going to find out. I think that's really interesting as well, because I do think that where I've seen a lot of pain at the moment is in that exactly that area, right? There's companies there who are looking to do it. Going back to Alistair, I know he's a big champion of doing that. He's all over the press at the moment talking about the need to support growth businesses and help them move on to the next level. So we were speaking about my thoughts about how we can sort of help that and move it on further forward and create some more visualization. So for what you guys are doing around that, I think it's exactly the right thing, and probably another part of your lucky strategy that seems to be working again. So I look forward to seeing more about that. I look forward to talking about it when next we meet. We'll try and be in the same country at some stage, and it'd be lovely to get you, me, and Mr. Hounslow as well together at some stage together to sit down and have a proper chat. But for now, Mark, an absolute pleasure having you on the show again. Thanks so much for doing it. Lovely to see you looking so well, doing so well, and long may it continue. Thanks for coming on the show.
Thank you for having me. It's always an absolute pleasure, and I hope you have a great holiday when you get to it.
Looking forward to it. Thank you all for watching. We will see you soon on our episode of FinTech Focus TV. Thanks a lot.